Right now, building wealth through property is becoming one of the most critical ways to secure the future of yourself and your family. We're living in a time where assets continue to rise while inflation slowly erodes people's ability to save. Every year that passes, it becomes harder and harder for the average person to get into the property market, own their own home, invest, and more importantly, become financially free. That's exactly why understanding how to invest in property properly matters more today than it ever has. Over the past 20 years, I've been a property investor. I've spent the last 8 years working as a mortgage broker, and I've also been involved in over $50 million worth of development projects. During that time, I've sat across from hundreds of investors at every stage of their journey. People who are just getting started, people who feel stuck, and people who are scaling their portfolios faster than they ever thought possible. So in this video, I'm going to walk through the exact framework that connects every decision you make, from setting foundations, buying your very first property, all the way through to building a portfolio that genuinely works for you instead of the other way around. This is what I have tried and tested in my own journey, and I've seen work for my clients who have executed properly. So if you're serious about understanding how property investing actually works, this might be one of the most important videos you ever watch. With that said, let's get into it. Before I talk about a single property, I want to name something that most investing content skips entirely, and that is your mindset. You don't want to focus on the media headlines. You don't want to focus on short-term gains. You don't want to buy based on what properties you personally like. You must invest based on what works for you financially. You pick the property based on the fundamentals, which I'll get into later in this video. You focus on the long term and let the effects of compounding growth do the heavy lifting, because time in the market beats timing the market every single time. A good example of this was COVID. Between 2020 and 2021, housing prices surged as a result of massive stimulus and a large amount of money being printed. Because I already owned property, that period ended up being an incredibly profitable period for me and genuinely changed my life. A lot of people assumed I must have had some sort of insider knowledge or that I just got lucky, but the truth is much simpler than that. I had been investing for years whenever it financially made sense, based on a fundamental belief that we live in an inflationary system. Over long periods of time, property prices are highly likely to rise. So I focused on buying assets that met the fundamental rules that I'd set for myself after educating myself and studying the game. When COVID came along, it accelerated that process dramatically. That was great, but the reality is they were very uncertain times. There was no way for me or anyone else to fully predict what was going to happen. What I was really betting on was the long-term idea of compound growth, and it paid off. This is the secret that almost no one talks about. When you focus on the long term, you give yourself more opportunities for luck to work in your favor. And even if nothing extraordinary happens, compound growth continues to work for you in the background. That is as certain as it gets. Now that you know the mindset you need to succeed, the focus turns to educating yourself so you can know how the game works before you play it. I made expensive mistakes in this journey, including a $250,000 development loss that I'll come back to. And when I look back honestly, almost none of those mistakes came from bad luck. They came from me acting before I was fully understanding what I was doing. The education I'd done wasn't wrong. I just hadn't taken it far enough. So if I was starting over again, the first thing I'd do is commit to deep, focused self-education across multiple angles. Dive into books like Daniel Walsh's 6 Principles to Retire Younger and Richer, Peter Span's Wealth Magic, or Steve McKnight's 0 to 130 Properties. Watch YouTube videos like this, take notes, and think about how you would apply that to your own situation. From there, I'd be in the right communities. Property Chat, Australian property investors on Facebook, property meetups, wherever and whatever I could find. The goal isn't to consume more theory, it's to get people around you who are actively doing what you're trying to do at different stages, so you can learn from their real experiences and not just their highlights reel. I'd be finding a mentor, someone who's built what I'm trying to build. Someone who can look at a decision I'm about to make and tell me what I'm not seeing. I cannot overstate how much a good mentor would have changed the trajectory of my early journey. The question isn't whether their time is worth paying for. It's whether your mistakes are worth paying for instead. Now that you've got the mindset to succeed, you're educated on the game you're playing, the focus shifts to building your team. Now here's where a lot of people underestimate what's actually required, because all the education in the world doesn't protect you from what you can't see on your own. I've talked about team in other videos. The core people you need here are your mortgage broker, your accountant, your property manager, and your conveyancer. And even possibly a buyer's agent if that makes sense for your situation. The best are all investors in themselves, so they fully understand what you're trying to achieve and the hurdles that come up so they can try and help you. If you're looking for a broker and ready to talk through what that structure actually looks like for your situation, there's a link below to book a call with my team. Brokers are paid by the bank, so it costs you nothing. With that said, let's get back into the video. Let me be direct about something that a lot of investing content glosses over. If you're not managing your money well right now, buying a property is not going to fix that. What it will do is amplify whatever's already happening, because now you've got a mortgage, rates, council rates, insurance, potential vacancies, unexpected repairs, all sitting on top of whatever you're already dealing with. The starting point is having a clear budget, a genuine savings habit, and a real understanding of where your money goes month to month. Not because that's all it takes to build wealth, but because without the foundation, everything else becomes fragile. Two things destroy borrowing capacity faster than almost anything else, and one of them surprises almost everybody I talk to. The obvious one is unsecured debt, personal loans, car loans, buy now, pay later. Banks see these as liabilities and they reduce what you can borrow accordingly. Pay them off before you apply. The one that surprises people is unused credit card limits. Here's what's actually happening. Let's say you've got a $10,000 credit card, zero balance, you haven't used it in months. The bank doesn't care. They have to assess what would happen if you went out tomorrow and maxed it out. So they assign a portion of that limit as a liability in their servicing calculator. That single $10,000 limit sitting there empty can reduce your borrowing capacity by around $60,000. If you've got 2 or 3 cards, you can quickly see how that adds up. The fix is simple. Cancel the cards you don't need before you apply for anything. You also want a financial buffer before you buy, not just a deposit, a buffer. Property investing is about holding an asset through all different market conditions, and conditions don't always cooperate. Vacancies happen, rates move, unexpected repairs come out of nowhere. Without a buffer, those moments force bad decisions. Selling at the wrong time, taking on expensive short-term debt, cutting corners on maintenance that could actually end up costing you more to fix later. 3 to 6 months worth of expenses, protected and not touched, is the baseline. And stress test your numbers before you commit. Too many first-time investors focus on what they can borrow rather than what they can actually afford if things shift. Run the numbers on a rate that's 2 points higher. Run them on a month of vacancy. Run them on a $15,000 repair bill landing in the same quarter. If the deal only works when everything goes perfectly, it's not a deal. It's a gamble dressed up as one. Once your financial foundations are solid, the next step is understanding what you can actually execute. And the single most important number in that conversation is your borrowing capacity. Not the number the bank gave you, your actual borrowing capacity across the market. And here's something that genuinely shocks most people when they see it. Borrowing capacity is not a fixed number. The same person with the same income, the same properties and the same expenses can have a borrowing capacity of $1.2 million with one lender and $2.89 million with another. I've seen that exact gap with a real client, and that is not a rounding difference. That's the difference between buying the next 2 properties or staying stuck. The reason for that gap is that every lender has its own serviceability calculator, its own treatment of different income types, and its own policies around what counts and what doesn't. One bank might take 3 months of your current overtime and annualize it. Another might compare the current year to the previous year and use whatever's lower. One might include your bonus income in full. Another might shade it by 20%. Same income, completely different result. This is why going to your bank and accepting what they tell you as your ceiling is one of the most limiting things you can do as an investor. You're not getting a market view. You're getting one opinion from one institution with one set of rules. Now let me explain the specific mechanism that causes most investors to hit a wall after property 2 or 3, because understanding this changes how you approach every subsequent purchase. Banks don't assess your ability to repay at the rate that you're actually repaying. They add a 3% buffer on top of that to test whether you could still service the loan if rates rose significantly. So if your actual rate is 6%, the bank is running its numbers at 9%. Applied across your existing loan simultaneously, plus the new one you're applying for, the repayments on paper look dramatically larger than what you're actually paying. That makes your surplus income look smaller. Less surplus income means less borrowing capacity, even when the real repayments feel perfectly comfortable. That buffer is a regulatory requirement, and and it exists for a good reason. Australia's conservative lending regulation is a meaningful part of why our property market didn't collapse the same way the US market did in the GFC. But from a practical investing perspective, it can make you feel like you're doing everything right and still getting blocked. The important thing to understand is that the wall is not the end. It just means that you need to know your options. On non-bank lenders, I want to keep this tight because the principle is simple. They are a legitimate strategic tool with a higher interest rate and a specific use case. The use case is keeping momentum when your major bank capacity is exhausted, but your income and equity trajectory is strong enough that you know you can refinance back to a major lender in the future. You go in with a clear exit plan. Income grows or debt reduces, or the portfolio value increases enough to make the major bank serviceability work again. Some lenders also have a specific policy where after 12 months of good conduct, they'll assess a refinance at a 1% buffer instead of 3%, which is often enough to make the switch back viable. Without that exit plan, you're not using a non-bank strategically. You're just paying a higher rate indefinitely. On trust structures, I'll address this because it comes up constantly and there's a lot of misinformation floating around. If someone has told you that a trust gives you unlimited borrowing capacity, I've got some bad news. A trust can be an effective tool in specific circumstances. For a lender to exclude trust debt from your personal serviceability, the trust needs to be trading profitably, self-sustaining and backed by an accountant's letter confirming this. If your portfolio is negatively geared in the early stages, which is common, the trust by definition is not profitable and it cannot get the letter. No letter, no exclusion, no strategy. The pool of lenders willing to do this treatment has also narrowed significantly with recent policy changes. Where trusts do work is for self-employed borrowers with high retained profit in their company structure, or high-income PAYG earners with the cash flow to make the trust genuinely self-sustaining from day one. And critically, it needs to be set up before you start building the portfolio. Switching from a personal name to a trust once you have multiple properties can trigger capital gains tax and stamp duty. It's not a restructure you want to do halfway through. The practical hierarchy is this. Start with major banks in your personal name. When you hit a serviceability ceiling, explore non-bank lenders and have a clear exit strategy. Consider trust lending only if your situation genuinely supports it and your accountant and broker have both done it before. Now that you understand what's been holding investors back and what real options are, the focus shifts from understanding the system to controlling it. That's where the decisions you make at the property level start to compound everything you've built on the finance side. The question I hear most often from people who are educated, financially ready, and still sitting on the sidelines is, when is the right time to buy? The answer is almost always now. Not because market conditions are always perfect, they're not, but because every month you spend waiting for the ideal conditions is a month the market is moving without you. The investors who wait for the perfect rate, the perfect economic environment, the perfect moment of certainty are consistently the ones who end up buying a comparable asset at a higher price than the one that they talked themselves out of. The cost of hesitation is almost always higher than the cost of imperfect timing. If you're in a position where income is there, but the cash deposit isn't built up yet, the parental guarantor structure is worth understanding. Instead of waiting years to save a full 20% deposit, the bank takes security over your parents' property provided it has sufficient equity in it. You get into the investment property without paying lender's mortgage insurance, which could save you 10k or 20k upfront. And your cash deposit is preserved, parked in an offset account from day one, and used as a foundation for the next purchase rather than being consumed by the first one. The non-negotiable part of this structure is a clear plan to release the guarantee over time. As the property grows in value to the point where it can stand on its own at 80% LVR, the guarantee gets released, and your parents' property is no longer tied to yours. That planning needs to be built into the structure from day one, with the guarantor's needs and financial position kept at the front of mind. I bought my first investment property in Richmond in Victoria in 2006 for $229,000. I didn't have a buyer's agent. I didn't have years of experience. What I had was a set of fundamentals that I'd built through a lot of reading, and a discipline to stick to them even when a more exciting option was in front of me. That property is still in my portfolio almost 20 years later, and it's worth around $500k, renting for $580 a week. That's a 13% yield on the original purchase price. Not because I picked a magic suburb, because I bought to the right fundamentals and held through the cycles. Here's what those fundamentals were and why each one still applies today. Strong rental demand first. Choose a location where people genuinely want to live right now. not where you hope they're going to want to live in a decade. Rental demand is what keeps your asset tenanted through market shifts and your yield consistent over time. For apartments, minimum 50 square meters internally. This isn't just about livability. Some lenders put restrictions on sub 50 square meter properties that can limit your refinancing options down the track. Clearing that threshold keeps your options open. At least 2 bedrooms. 2 bedrooms gives you flexibility to rent to a couple, to individual sharing, or to a single tenant who might want a home office. You open up your tenant pool significantly, and you have options when market conditions change. Low strata costs, no pools, no lifts, no concierge, no gym. Every amenity in a strata complex generates ongoing levies that eat into your net yield. The simpler the building, the more predictable your costs, and the stronger your effective return. A small block, 1 of 12, holds value well, and its desirability is very different to 1 in 200. Scarcity matters to buyers, and it matters to tenants too. And buy something you can add value to. Even without renovation skills, cosmetic upgrades can change the feel of a property enough to move the needle on rent. Paint, carpet, and updated fixtures can be that simple. A $5,000 to $10,000 spend might add $80 to $100 a week in rent, and is a return that almost nothing else in your financial life can match. Here's something most property content never addresses. Your career isn't just the thing that pays your mortgage. It's one of the most powerful levers that you have for scaling a portfolio, and most investors treat it as a fixed variable when it isn't. Your income directly drives your borrowing capacity. If your income growth is capped, your ability to keep building gets capped with it. That ceiling is real, and I hit it hard in my own journey when I was a salaried employee with limited upside. You can push for promotions, you can change employers, but in a standard salary role, there's only so much you can do to influence the number. Roles with genuine earning upside change that equation. Commission-based roles, high-income professional fields, anything where your performance has a real impact on what you take home. The added benefit is that the banks look at bonus and commission income as a positive signal, though they treat it differently between lenders. Some average 2 years of history, some will use the most recent year. A broker who understands these policies can help you present that income in the most favourable way. And on the side hustle piece, if you can build income under an ABN and document it properly through 18 months of tax returns, that income can start to count towards your borrowing capacity. It's not instant, but 18 months of genuine, documented business income opens a door that casual hours or a second job never will, because that business is scalable in a way that trading extra time for extra dollars isn't. Once you've got that first property, the momentum shift is real. You've got equity starting to build, rental income coming in, and proof to yourself that you can actually execute this. That proof matters more than most people acknowledge. Confidence built on a real result is different to confidence built on theory. The goal from here is property number 2. It's deliberately and as quickly and as responsibly as execution allows. Before making any moves, get your broker to model your borrowing capacity across the full lender landscape, not just your existing bank. Clean up any liabilities that are dragging your number down. Cancelled cards, paid out personal loans, anything that's adding to your assessed obligations without adding to your life. Ideally, property number 2 has a value add element, not because you need to renovate everything you buy, but because an asset with clear upside that the current price doesn't fully reflect can accelerate your equity position faster than a passive buy at full market value. The cosmetic renovation approach, paint, carpet, lighting, updated fixtures can be done without specialist skills and can move your yield enough to materially improve your cash flow and your borrowing capacity for the next purchase. As you're working toward property 3, that's where the non-bank lender conversation becomes relevant if your major bank borrowing capacity starts to feel tight. You've already got the framework, use it as a bridge with a clear exit plan and income or equity growth working in your favour. Here's a principle that I applied consistently across the portfolio and it compounded significantly over time. Every property you buy should have a value add lens applied to it. Not because you need to renovate, but because the investors who outperform the market aren't just tracking it. They're actively doing something to improve the position of every asset that they hold. Early on, value add is cosmetic and deliberately low risk. Paint, carpet, lighting, fixtures, things that require minimal skill, minimum spend, and produce a measurable and immediate improvement to the rental yield. I've seen $3,000 cosmetic refreshes add $80 per week in rent. That's 140% return in year 1. If you can find that return anywhere else in your financial life, tell me about it. And as you move further along value add scales, a DA approval for an extension, converting a 2-bedroom, 1-bathroom property into a 3-bedroom, 2-bathroom through a well-managed renovation. We did exactly that near and west of Sydney with a terrace. Purchase price of $725, $250k of work, and ended up selling that for $1.36 million. The net margin there was $385k. And because it was our owner-occupied residence, there was no capital gains on any of it. And then development. That's where the real scale is, but also where real risk lives. And I want to be honest about both. We jumped into development in 2010. 4 townhouses in Hurstville, $1.1 million purchase, and it became one of the most expensive lessons of my life. Not because the site was wrong. The site was actually excellent, as the market eventually proved. The builder who bought it from us at a loss made $675,000 profit. And comparable properties in that block have since sold at over $1 million each. We lost $250k because we didn't have the right team. Our architects had no idea what they were doing, and we didn't know enough to know that, which meant that we didn't find out until we'd been rejected by council 3 times, burnt through 2 years of holding costs, and arrived at a position where selling was the only way out. The lesson isn't don't do development. We came back to it. Built a proper team, found a draftsman who actually understood the approvals process, and our first successful duplex project generated $1.1 million in net profit over an 18-month period. The lesson is to understand the game before you play it, and find a mentor who's been through it. One conversation with someone who has done a successful development could have saved us $250,000 and 2 years. That is the single most expensive mistake I've ever made, and it was completely preventable. Development is a completely different game from buy and hold. The upside is real, but so is the downside. By the end of 2014, we had 12 properties with a combined value of around $5 million. And because we'd held many of them for an extended period, the rental income had grown to the point where the portfolio was positively geared. Money was coming in every month rather than going out. And that shift from portfolio building to portfolio performing is what financial freedom actually looks like in practice. And it doesn't happen through one big decision. It happens through consistent, strategic action over a long time, with the economic system doing a significant amount of the work for you. Australia operates in an inflationary economic system. That means that prices generally rise over time, and property, sitting in that system with leverage, with a tenant partly covering your costs, in location where demand structurally outprices supply, benefits from that inflation in a way that compounds over decades. If you hold a fundamentally sound asset in a high demand location through market cycles, you will see significant capital growth. That is not a guarantee in any given year. Across 10, 15, 20 years, the track record is consistent and has been so for generations. The optimization along the way is what separates good outcomes from great ones. Small improvements to yield, strategic refinancing to unlock equity for the next purchase, keeping costs lean, maintaining assets well, and through all of it, patience. The longer you hold, the more time you give to the compounding to work. That is where the real wealth is generated, not in the buy, in the holding. Now I want to talk about something that doesn't get nearly enough airtime in property investing content. Not because it's complicated, but because people who understand it tend to move quietly and let it compound. It's called debt recycling. It is about restructuring your existing debt in a way that quietly improves your tax efficiency, reduces non-deductible debt you're paying, and sets you up to keep you scaling without taking on more risk. Here's the most common way people approach buying an investment property when they already own their own home. They save up cash, they build up the offset account, and when they've got enough for a 20% deposit plus stamp duty, they pull it out and use it. It's logical, but that approach is actually costing them. When you pull cash out of your owner-occupied offset account, you're reducing the amount sitting against your home loan. That increases the interest you're paying on non-deductible debt. At the same time, the investment loan is as large as it needs to be, but you funded the deposit with cash that was doing useful work somewhere else. The smarter move is to leave your cash where it is against the owner-occupied loan, and instead release equity from the property as a separate loan split to fund the deposit, stamp duty, and costs for the investment. Because those funds are being used for investment, the interest is tax deductible. Your cash stays against the non-deductible debt, continuing to reduce the interest you pay there. You're maximizing deductible debt and minimizing non-deductible debt simultaneously. As you continue to pay down your owner-occupied loan, more equity builds. You release that equity as another clean loan split. You use it for the next investment. Each time you do this, you're converting non-deductible debt into deductible debt. The tax efficiency improves with every cycle. The end state is zero non-deductible owner-occupied debt with only tax-deductible investment debt sitting against your home. Same house, completely transformed debt structure. And if you want to go even further, some banks have a specific debt recycling product that lets you continue cycling capital without a full new application each time, which is especially powerful for investors who also want to allocate into shares alongside property. Now that you understand how to use equity correctly, let me walk you through what actually determines whether you can access it in the first place. Because this is where a lot of investors get a nasty surprise. There are 3 filters and all 3 need to work in your favour. The first is the lender's policy on releasing equity. Some will let you borrow up to 80% of your property's value without asking detailed questions around what the funds are used for. Others will cap the equity release at specific amounts, say 100 or 250k, and anything above that threshold requires detailed documentation around purpose and repayment. This matters when you're trying to get ahead of the market and prepare a deposit before you've even found the next property. Knowing which lenders have the most flexible release policies is a meaningful advantage. The second filter is the bank valuation, and this is the one that catches people off guard more often, because the difference between what you think your property is worth and what the bank will lend against it can be significant, and that gap varies enormously between lenders. I had a client recently whose existing lender came back and said there was 0 equity available. None. The deal looked completely dead, but we ran upfront valuations with 7 different lenders. 2 came back with valuations over 900k, which was enough to unlock 45k in usable equity and allow the next purchase to proceed. Same property, same owner, just a smarter approach to lender selection. The additional piece on valuations worth knowing is that a full in-person valuation, where a licensed valuer physically inspects the property and reviews comparable sales, can be influenced if you're prepared. Not manipulated, but by presenting strong, well-supported comparable sales evidence through your broker to the valuation firm, you give the valuer every reason to arrive at the most defensible number. An automated system valuation just spits out a figure and that's final. There's no room for a conversation, but with a human valuer there is. The third filter is your serviceability with that specific lender. Even if the valuation's strong, and even if the policy allows the release, you still need to demonstrate you can service the additional debt. And as we've covered, every lender calculator services differently. The same income can produce dramatically different results depending on which institution you're talking to. All 3 of these filters working simultaneously is why going to the one bank and accepting their answer is almost never the right approach. A broker can run all 3 filters across multiple lenders in a single process without damaging your credit file and identify the path that actually works for your situation. I want to address rent vesting here because it's a strategy that gets dismissed too quickly by people who've been conditioned to believe that owning your home is always the most important financial priority. Rent vesting is simply renting where you want to live and deploying your capital and borrowing capacity where it generates the best return. The reason that it's worth considering is that in expensive cities, the cost of ownership can be dramatically higher than the cost of renting, and the difference is capital that could be working harder elsewhere. Here's how I actually thought about this in my own situation. When we sold our owner-occupied home to fund our duplex development. Instead, what we did is rented a 5-bedroom property which was worth $3.3 million for $1,850 per week. The opportunity cost of actually buying that property would have been about $132,000 a year. We accessed a significantly better lifestyle for less than what the ownership would have cost, while our capital was working for us in a development project that generated $1.1 million in net profit. Rent vesting is not the right answer for everybody, and it's not a permanent state. It is a strategic tool for specific stages of a portfolio journey, where your capital and borrowing capacity can generate a better return deployed elsewhere than if it was sitting in your family home. The numbers tell you when that's the case, if you're willing to actually run them. I want to close out with the practical mechanics of actually buying and settling a property, because this is where a lot of investors who have done everything right quietly lose money or create problems for themselves. In negotiation, the trap I constantly see is this. An investor does everything right, finds a good property, has their pre-approval, runs the due diligence, and then walks away from the deal over a $5,000 to $10,000 gap in price. Then they sit on the sidelines for 6 months while the market moves until they eventually buy something comparable at a higher price, and often a lesser asset. The cost of a lost opportunity is almost always higher than the cost of bridging a small gap with a genuinely good asset. Know when to commit. On due diligence, once you're moving forward towards unconditional, you need to be thorough. For a house or townhouse, a building and pest report is non-negotiable. It tells you whether there are structural issues, moisture problems, or anything that could become expensive. For a strata property, the strata report is equally important. It shows you what issues the building committee has already identified and whether there are planned levies coming out that you'd inherit as the new owner. On pre-approval, make sure it's fully credit assessed before you make any offers. A system-generated pre-approval can still collapse at formal approval when a human reviews the file. A fully credit assessed pre-approval has already gone through that review, which means the conversion to formal approval is essentially just confirming the valuation. And that lets you make an unconditional offer with real confidence. On settlement, engage your property manager the moment the contract is exchanged. Get them working on finding a tenant immediately. Every week of vacancy is income you're not earning. If you're planning cosmetic work before the first tenant, use the settlement period to get trades through for quotes so you can hit the ground running from day one. And set the whole thing up to run as hands-off as possible from the start. Direct debits for the loan, direct debits for the council, for insurance, and other costs. An offset account as a central hub with income flowing in and expenses flowing out. Maintenance dealt with properly. The properties that perform well over the long term are almost always the ones that were set up to run smoothly from day one, and that doesn't happen by accident. Success in property doesn't come from one great decision. It doesn't come from picking a perfect suburb or timing in a cycle and finding a strategy that nobody else knows about. It comes from understanding that every decision in this journey connects to the next one. The mindset creates the patience to hold. Education creates judgment to buy right. The team creates the structure to scale. The finance setup creates the runway to keep going. The equity strategy transforms what you've already built into fuel for what comes next. Every wall I hit, and there were many, either turned into a lesson or a lever. The development loss taught me more about how to do it right than any book ever could. Hitting the borrowing capacity ceiling pushed me to understand finance from the inside out. The career ceiling became the reason I started my own business. The pattern is consistent. The investors who build real wealth through property are not the ones who avoid obstacles. They're the ones who understand what the obstacle is actually made of and figure out how to move through it. Wherever you are right now, the next step is clearer than you think. If you're just starting, the foundation is mindset, education, and team. If you've got one or two properties and you're feeling stuck, the answer is almost always in your borrowing structure or in your lender selection. If you're further along and trying to accelerate, look at how your equity is set up and whether debt recycling could be doing more work in the background than it currently is. And whatever stage you're at, review your lending setup at least once a year. Lending policies change, your income changes, your portfolio changes. What was optimal 18 months ago may be quietly costing you today. The link below will get you in a conversation with my team. We'll look at your actual numbers, your current structure, and what's actually possible from where you are right now. It costs nothing because brokers are paid by the bank, but the clarity that comes out of it can change the timeline significantly. Thanks for watching. I'll see you in the next one.